Before we begin, a quick and important disclaimer. I am not a licensed financial advisor, mortgage lender, or real estate agent. The information provided in this video is for educational and informational purposes only and should not be considered financial, legal, or tax advice. Buying a home is one of the biggest financial decisions you will ever make. Please consult with a qualified professional, like a loan officer and a real estate agent, to discuss your individual situation before making any decisions. This presentation is designed to empower you with knowledge, so you can ask the right questions and make the best choice for you. You're doing it. You're scrolling Zillow late at night. You find it. The one. It has the perfect kitchen, the backyard for the dog. It's in the right school district. You're already imagining where your couch will go. Then your eyes drift down to the estimated monthly payment, and your heart sinks a little. You pull out your phone's calculator, you type in the price, and you multiply it by 0.20, 20%. And the number that pops up on the screen is staggering, feels completely, utterly impossible, like a finish line that's 1,000 miles away. And in that moment, the dream of that house, of any house, just evaporates. What if I told you that number, that 20% number that just crushed your spirit, is the single biggest myth in American real estate? What if I told you that for decades millions of Americans have been held back from building wealth through homeownership because of this one outdated and frankly misunderstood piece of advice? And what if I told you that by the end of this video, you will not only understand why it's a myth, but you will know the actual amount of money you need to buy a home? You will have a clear, actionable roadmap. The confusion will be gone. The impossible number will be replaced by a real, achievable goal. That feeling of being locked out of the American dream? We're going to replace it with a key. So let's kill this myth right now. Where did the 20% rule even come from? It's not a law. It's not a requirement for most loans. It's simply the threshold to avoid something called PMI, or private mortgage insurance. That's it. Think of PMI as an insurance policy that you pay for, but it protects the lender, not you. If you put down less than 20%, the lender sees you as a slightly higher risk. So they require you to pay for this insurance policy until you've paid down your loan enough to have 20% equity in your home. For years, people have talked about PMI like it's a monster under the bed, a terrible penalty you must avoid at all costs. But here's the truth. PMI is not a penalty. It's a tool. It's a key. It is the very thing that allows millions of people to buy a home with a much smaller amount of money up front. Paying a couple $100 extra a month in PMI in order to get into a home now, and start building your own equity instead of your landlord's, is often one of the smartest financial moves you can make. You can get rid of it later, but you can never get back the years of appreciation and equity you miss out on while waiting to save up an imaginary 20%. So, if 20% is the myth, what's the reality? Let's talk real numbers. What if you could buy that dream house with 5% down? Or 3.5% down? Or what if, for many of you watching, you could buy a house with 0% down? It's not a gimmick. It's not a scam. These are real, government-backed and conventional loan programs used by millions of your friends and neighbors. Let's go back to that house you were looking at. Let's say it costs $400,000. The 20% myth tells you that you need $80,000 cash. That's a mountain to climb. But what about an FHA loan, one of the most popular programs for first-time homebuyers in the United States? The minimum down payment is 3.5%. On that same $400,000 house, your down payment is just $14,000. Let me say that again. Not $80,000, $14,000. Now, does that feel a little more possible? Does that finish line suddenly feel a whole lot closer? What about a conventional loan? The one everyone thinks you need 20% for? Many lenders offer conventional loans for as little as 3% down. That's $12,000. Are you a veteran and active duty service member? Or a surviving spouse? The VA Home Loan Program, one of the best financial benefits you've earned through your service, requires $0 down. Nothing. And for those looking to buy in designated suburban or rural areas, the USDA loan also requires $0 down. From $80,000 to $14,000 to $12,000 to zero. This is the reality of the down payment in America today. Now, your brain is probably spinning. You're thinking, okay, this is amazing, but it can't be that simple. What about closing costs? What about other fees? And you are 100% right. The down payment is just one piece of the puzzle. When you're saving up to buy a house, you need to think about 3 distinct buckets of cash. Memorize this because it will simplify the entire process for you. Bucket number 1 is your down payment. Bucket number 2 is your closing costs. And bucket number 3 is your cash reserves. We're going to break down all three, but for now, let's focus entirely on that first most misunderstood bucket, the down payment itself. What is it exactly? Your down payment is your initial stake in the home. It's your skin in the game. It's the portion of the home's purchase price that you pay up front, out of your own funds, while the lender finances the rest. So, on that $400,000 house with a $14,000 down payment, you own 3.5% of the house on day one, and the bank has a loan out for the other 96.5%. It is not a fee you pay to the lender. It's not money that disappears. It is the very first brick of equity you lay in your own financial foundation. Every dollar of your down payment is a dollar of the home's value that you own outright from the moment you get the keys. So let's quickly recap the major loan types and their real minimum down payments. This is the cheat sheet you wish you always had. First, the FHA loan. This is insured by the Federal Housing Administration. It's incredibly popular because it's designed to help people get into homes. It requires just 3.5% down, and it's more forgiving on credit scores than other loan types. This is the workhorse of the first-time homebuyer world. Second, the conventional loan. This is any loan that isn't backed by the government. This is where the 20% myth lives and breathes. But the reality is, programs like the conventional 97 allow you to buy with just 3% down. That means the lender finances 97% of the home's value. These loans often require a slightly higher credit score than FHA, but they can be a fantastic option. Third, the VA loan. If you have served our country, please listen closely. This program is administered by the Department of Veterans Affairs, and it is a game changer. For most eligible veterans and service members, it requires 0% down. I'll say it again, 0. It's one of the most powerful homeownership tools in existence, a benefit you have absolutely earned. And fourth, the USDA loan. This is a lesser-known but incredible option from the U.S. Department of Agriculture. It's designed to promote homeownership in less dense areas. If the property you want to buy is in an eligible rural or suburban zone, and you'd be shocked at what qualifies, you could get a loan with, you guessed it, 0% down. So let's look at our $400,000 house one more time, but through the lens of reality. With the 20% myth, you need $80,000. With a 5% conventional loan, you need $20,000. With a 3.5% FHA loan, you need $14,000. With a 3% conventional loan, you need $12,000. And with a VA or USDA loan, if you qualify, you need 0. Seeing the numbers laid out like this, the path to homeownership no longer looks like an unclimbable cliff. It looks like a series of steps. It looks possible. So now you understand the what, the real percentage you actually need. But this leads to the next, even more important question. Where can this money actually come from? Because the answer is so much bigger than just my savings account. And understanding all your options is the key to getting there faster than you ever thought possible. Let's start with the most obvious source, the one everyone thinks of first, your personal savings. But even this has layers you might not expect. We're not just talking about the checking account you use for groceries. To a lender, that money is volatile, it's unpredictable. They want to see a stable, dedicated source of funds. This is where a high-yield savings account, or HYSA, becomes your best friend. Not only does it pay you significantly more interest than a traditional savings account, helping your down payment grow on its own, but it also creates a clean, separate bucket of money. When a lender sees consistent deposits into a dedicated savings account over several months, it tells them a story. It says you're disciplined, you're a planner, and this home purchase isn't a whim. It's a documented goal. They love that. They want to see that the money has been sitting there, seasoning, for at least 2 to 3 months. We'll talk more about that critical word, seasoning, later, because messing it up is one of the fastest ways to get your loan denied. For now, just know that building a dedicated savings history is step 1. But what if your savings account isn't growing fast enough? What if you're looking at the numbers and thinking, at this rate, I'll be able to buy a house in 10 years. This is where we get into the strategies that can literally shave years off your timeline. Let's talk about the most common accelerator, a gift. This is a game changer for millions of homebuyers, but it's also a minefield of mistakes. You can't just have your parents or a relative drop $20,000 into your checking account the week before you apply for a loan. To a lender, a large, sudden, undocumented deposit is the biggest red flag in the universe. Their first thought isn't, "Oh, how nice, a gift." Their first thought is, "That's an undisclosed loan. They see it as a secret debt that you'll have to pay back, which affects your ability to pay your mortgage. And an undisclosed loan is grounds for immediate denial. So how do you accept a gift the right way? You document everything with a gift letter. This is a simple, one-page document, but it is non-negotiable. It has to state the giver's name, address, and relationship to you. It needs to state the exact dollar amount of the gift. And most importantly, it must include a sentence that says, in no uncertain terms, this is a bona fide gift, and there is no expectation of repayment. The person giving you the money has to sign it. You have to sign it. This letter turns a giant red flag into a green light for the lender. You'll also need to show the paper trail. The money leaving the giver's account and entering yours. A copy of their bank statement showing the withdrawal, and your statement showing the deposit. It feels a bit invasive, but it's the only way to prove to the bank that this money is truly yours, free and clear. So if you're lucky enough to have family who can help, don't let a simple paperwork mistake derail your dream. Okay, so savings and gifts are the two big ones. But now let's talk about a source that many people consider, but few truly understand, your own retirement account. This is the break glass in case of emergency option, and buying a house often qualifies. The most common way people do this is by taking a loan from their 401k. The appeal is obvious. You're borrowing from yourself. The interest you pay doesn't go to a bank. It goes right back into your own retirement account. Feels like a win-win. You can typically borrow up to 50% of your vested balance, capped at $50,000. And for the purpose of buying a primary residence, this is a perfectly acceptable source of funds for a lender. But you have to understand the risks. The big one is your job. If you lose or leave your job, that 401k loan usually has to be repaid in a very short amount of time, often within 60 days. If you can't, it's treated as an early withdrawal. That means it becomes taxable income, and you'll get hit with a 10% penalty on top of that if you're under age 59 and a half. Suddenly, your $50,000 down payment becomes a $35,000 down payment, plus a massive unexpected tax bill. The other risk is opportunity cost. The money you borrow is no longer invested in the market, meaning you miss out on any potential growth while the loan is outstanding. So, a 401k loan can be a powerful tool, but it is not free money. It's a calculated risk you need to be comfortable with. There's another, often better, option hiding in your retirement portfolio: a Roth IRA. If you have a Roth IRA, the IRS allows you to withdraw your direct contributions, not the earnings, just the money you put in at any time for any reason, completely tax and penalty free. That money has already been taxed. It's yours. On top of that, first-time homebuyers can withdraw up to $10,000 of earnings from their Roth IRA without paying the usual 10% penalty, though you may still owe income tax on those earnings. This makes a Roth IRA an incredibly flexible vehicle for saving for a down payment, a secret financial superpower that most people don't even know they have. Now let's move from using your own money to using other people's money, specifically the government's. I'm talking about down payment assistance programs, or DPAs. And this is the part where you should lean in, because this is the single most overlooked source of funds in American real estate. So many people hear assistance program and immediately think, oh, that's not for me, I make too much money. And for so many of you, that is absolutely wrong. These programs are not just for low-income individuals. They are designed to help firefighters, teachers, nurses, and millions of middle-class families become homeowners. The income and purchase price limits are often much higher than you'd think, especially in high cost of living areas. These programs are typically run by state or local housing finance agencies, and they come in a few different flavors. First, you have grants. This is the holy grail. A grant is a gift. It's money you are given for your down payment that you never have to pay back. It's literally free money to help you buy a house. They are competitive, but they are out there. Second, and more common, are forgivable loans. This is a loan for your down payment, say $10,000 or $20,000, that acts as a silent second mortgage. It has no monthly payment. And here's the magic part. It's forgiven over time. For example, the program might say that for every year you live in the house as your primary residence, they will forgive 20% of the loan. So after 5 years, the loan completely disappears. You never paid a dime on it. They are essentially paying you to live in your own home. Third, you have simple second mortgages. These are low-interest or even zero-interest loans that cover your down payment and closing costs. You do have to pay them back, but often the payments are deferred for years, or they only become due when you sell or refinance the house. This lets you get into a home now with very little out of pocket, and pay the assistance back later with the equity you've built. Finding these programs is as simple as going to Google and searching for your state housing finance agency or your city down payment assistance. You will be shocked at what you find. It could be the difference between buying a home next year and buying a home next decade. Finally, there are a few other places the money can come from. You can of course sell assets. This could be stocks, mutual funds, or cryptocurrency. The key here is to be mindful of taxes. When you sell an asset for a profit, you owe capital gains tax. You need to factor that into your calculation so you don't come up short at the closing table. Talk to a tax professional before you liquidate a large investment. So let's quickly recap. Your down payment can come from your dedicated, seasoned savings. It can come from a properly documented gift from family. It can be a calculated loan or withdrawal from your own retirement accounts. It can come from incredible down payment assistance programs you probably qualify for. Or it can come from the sale of other assets. You have so many more options than you thought. The money is very often within reach. You've identified your sources, the gift from your parents, the 401k loan, that DPA grant you just discovered. You feel unstoppable. But this is where 90% of first-time buyers make a critical mistake. A simple, innocent-looking transaction that can get your entire loan application thrown in the trash. And it all comes down to one word: seasoning. In the next part, we're going to break down exactly what that means and how to avoid the single biggest red flag your lender is looking for. So what is seasoning? It sounds like something you do to a steak, but in the mortgage world, it's the single most important concept for your down payment money. And getting it wrong is like serving that steak raw to the pickiest food critic in the world, your loan underwriter. They will send it right back, and by it, I mean your entire homeownership dream. Seasoning is simply a period of time that your down payment funds have been sitting in your bank account. Think of it as a quarantine period for your cash. Lenders need to see that the money is legitimately yours, that it's stable, and that it hasn't just magically appeared out of thin air. Why? Because their entire business is built on managing risk. They are lending you hundreds of thousands of dollars, and they need to be absolutely certain about two things: that you are who you say you are, and that your money is what you say it is. A large, sudden, unexplained deposit of cash into your account just weeks before you apply for a mortgage is the biggest, brightest, most blaring red flag you could possibly wave in a lender's face. To an underwriter, that sudden cash infusion doesn't look like a gift from your loving grandma. It looks like potential fraud. It looks like a secret, undocumented loan from a shady source that you'll have to pay back. A debt they haven't accounted for, which could wreck your ability to pay your mortgage. Or, in a more extreme case, it could even look like money laundering. They don't know, and they're not paid to take chances. They're paid to say no to anything that smells even slightly off. Let me tell you about a couple. We'll call them Mark and Sarah. They did everything right. They worked for years, saved diligently, got their credit scores into the high 700s, and had a stable joint income. They found the perfect little 3-bedroom house in a great school district. They had their 20% down payment, $80,000, sitting in a savings account. They were the perfect applicants, or so they thought. About a month before they started their house hunt, Sarah's uncle, ecstatic that his favorite niece was buying a home, gave them a wedding gift a little late. He handed them an envelope with $10,000 in cash. "For the new furniture," he said. Mark and Sarah were thrilled. They went straight to the bank and deposited the full $10,000 into the same savings account where their down payment was. They didn't think twice about it. It was a gift. It was their money. What could be wrong? Everything. When they submitted their loan application, the lender asked for the last 2 months of bank statements. And there it was, sticking out like a sore thumb. A single clean $10,000 cash deposit. The loan officer called them immediately. "We have a problem," he said. "The underwriter has flagged this deposit. Where did this money come from?" This is the seasoning rule in action. Lenders will typically scrutinize the last 60 days of your financial life. Any money that has been sitting in your account for longer than that 60-day window is considered seasoned. It's aged. It's trusted. It's part of your established financial history. But any large, non-payroll deposit that shows up within that 60-day window is unseasoned. It's fresh, it's new, and it's suspicious. The lender requires you to source it, which means you have to prove with a mountain of documentation exactly where every single dollar came from. For Mark and Sarah, panic set in. They explained it was a gift, but the underwriter's response was cold and procedural. "Prove it." This is where knowing the rules ahead of time can save you from a world of stress. If you have unseasoned funds, you need a paper trail. Let's break down the most common scenarios. First, gift money, just like Mark and Sarah's. This is probably the #1 reason funds get flagged. If a family member gives you money for your down payment, you cannot just deposit the cash and call it a day. You need what's called a gift letter. This is a formal document signed by the person giving you the money. It has to state their name, their address, their relationship to you, the exact dollar amount of the gift, and this is the most important part: a clear, unambiguous statement that the money is a true gift with no expectation of repayment. It is not a loan, period. But it doesn't stop there. The underwriter isn't just going to take your uncle's word for it. They'll likely want to see the money trail from both sides. They'll want a copy of the check or wire transfer, and they may even ask for a bank statement from the person who gave you the money, showing the funds leaving their account. This feels incredibly invasive, but it's standard practice. They are verifying that the gift giver actually had the money to give, and that it wasn't secretly funded by some other loan. Second scenario, you sold something valuable. Maybe you sold a car, a boat, or some expensive collectibles to raise cash for your down payment. You can't just deposit that $15,000 and expect the lender to be okay with it. You need to create a paper trail. You'll need a copy of the bill of sale, clearly showing the buyer, the sale price, and what was sold. If it was a vehicle, you'll need a copy of the signed-over title. You'll need a copy of the cash check or a bank statement showing the electronic transfer. You have to connect the dots for the underwriter so they can see: asset existed, asset was sold, funds from sale were deposited. It's a clear, logical story. The third and most dangerous scenario is what's often called mattress money. This is physical cash you've been saving at home for years. This is the absolute hardest to source and the most likely to get your application denied. You cannot, under any circumstances, walk into your bank a month before applying for a mortgage and deposit $20,000 in cash. It is the reddest of all red flags. It screams undisclosed source. So what do you do with legitimate cash savings? The only answer is, plan way ahead. You need to get that money into the banking system at least 3 to 6 months, long before you even think about talking to a lender. Deposit it and let it sit. Let it get old. Let it become seasoned. Once it has been in your account for more than that 60 or 90-day review period, it just becomes part of your established balance. No questions asked. So what happened to Mark and Sarah? It was a nightmare. They had to go back to Sarah's uncle and ask him for a signed gift letter, a copy of his bank statement, and proof of where he got the cash in the first place. It was awkward and stressful. The uncle, a small business owner who dealt in a lot of cash, had to dig up his own records. The whole process delayed their closing by 2 weeks, and they almost lost the house to a backup offer because they couldn't get their financing finalized in time. They eventually got it done, but the stress nearly broke them, all because of a simple mistake that could have been avoided if they had just asked the uncle to write a check instead of giving them cash, and if they had gotten the gift letter signed the moment they received it. The lesson here is to start thinking like an underwriter. From the moment you decide to buy a home, your bank account is no longer a private matter. It's a public record of your financial responsibility. Every dollar needs a story. Keep your accounts clean and simple. Avoid large, unusual cash deposits or transfers. If you are getting a gift, get the paper trail in order immediately. If you're selling an asset, document it meticulously. Seasoning your funds isn't just a bureaucratic hoop to jump through. It's the foundation of trust between you and your lender. By showing them a stable, well-documented financial history, you're not just proving you have the money, you're proving you're a reliable and low-risk investment. But here's where it gets even trickier. Even if your money is perfectly seasoned, the source of that money itself can be a deal breaker. There are certain types of funds that lenders consider unacceptable, even if they are perfectly legal and have been sitting in your account for years. Using money from one of these sources is like building your house on a sinkhole. And the most common one is a trap that millions of Americans fall into every single year. That trap is cash. Cold, hard cash. The money you saved in a safe, the $100 bills you got from selling your car on Craigslist, the graduation money you've kept in an envelope for a decade. To a mortgage underwriter, large unsourced cash deposits are the reddest of red flags. They call it mattress money, and to them it's radioactive. Why? Because they have no idea where it came from. In a world governed by anti-money laundering laws and the Patriot Act, a sudden $10,000 cash deposit looks less like diligent saving and more like potential criminal activity or, just as bad, an undisclosed loan from a friend that you're expected to pay back. Lenders are legally required to verify the source of every single dollar you use for your down payment. If they can't create a clean, unbroken paper trail for that money, they cannot use it. It's that simple. This leads to one of the most important concepts in the entire mortgage process: the idea of seasoning your funds. Lenders will typically ask for your most recent 2 to 3 months of bank statements. That's usually a 60 to 90-day window. Any money that has been sitting in your account for that entire period is considered seasoned. The lender assumes it's your money, and they don't ask any further questions about its origin. But any large, non-payroll deposit that appears within that 60-day window will be put under a microscope. Let me paint you a picture. Meet Mark and Sarah. For 5 years, they've been stashing away cash from side hustles. Mark's a freelance photographer, and Sarah sells custom furniture. They've saved up $25,000, all in cash, stored in a fireproof box. They find their dream home, get pre-approved, and 3 weeks before closing, they walk into their bank and deposit the entire 25 grand. They're proud. They did it. A week later, they get a frantic call from their loan officer. The underwriter has flagged the deposit. They need to source it. Mark and Sarah send over a letter explaining, "This is cash we saved from our side businesses." The underwriter responds, "Not good enough. We need proof. Invoices, receipts, separate business bank statements for the past 2 years showing a pattern of these cash earnings." But Mark and Sarah didn't keep meticulous records. They just did jobs for cash. Their entire life savings, the key to their new home, has just become a toxic asset. Their loan is denied, and they lose the house, all because they didn't understand the seasoning rule. The tragic part is, this was completely avoidable. If they had deposited that cash into their savings account 6 months before they even started looking for a house, it would have been fully seasoned. By the time they applied for the loan and submitted their bank statements, that $25,000 deposit would have been old news, a non-issue. The money would be considered their own, free and clear. So if you have cash savings, the strategy is simple. Deposit it into your bank account today. Do not wait until you're ready to buy. The clock on that 60-day seasoning period needs to start ticking as soon as possible. Every day you wait is a day you push your homeownership goal further into the future. This same principle of documentation applies to another massive sinkhole: gifts that are actually loans. It's incredibly common. Your parents, a sibling, or a grandparent wants to help you with the down payment. They give you $20,000. On the surface, this is great. Lenders are perfectly fine with gift funds provided they are, in fact, a true gift. The problem arises when there's a wink and a nod agreement that you'll pay the money back over time. If an underwriter gets even a whiff of this, your application is toast. Why? Because a secret loan that you have to repay is an undisclosed debt. It directly impacts your debt-to-income ratio, or DTI, which is one of the most critical calculations in determining if you can afford the mortgage. By not disclosing this side loan, you are misrepresenting your financial situation. It's a form of loan fraud. Lenders have seen it all. They know what to look for. They'll see a large transfer into your account from your dad, and then a month later, they'll see a $500 transfer from you back to your dad, with the memo "Thanks again." Red flag. They'll scrutinize your bank statements for any regular, repeating payments to individuals that look like a loan repayment. To do this the right way, you need an ironclad gift letter. This isn't just a friendly note. It's a formal legal document. The person giving you the money, the donor, must sign a letter that explicitly states their name, your name, their relationship to you, the exact dollar amount of the gift, and the address of the property you're buying. And it must contain this magic sentence: "This is a bona fide gift, and there is no expectation of repayment, either expressed or implied." Without that specific language, the letter is worthless. The lender will also need to see the money trail: a copy of the donor's bank statement showing the funds leaving their account, and a copy of your bank statement showing the funds arriving in yours. It has to be a clean, verifiable transfer. No cash handoffs. The third financial sinkhole is the most modern and, for some, the most confusing: cryptocurrency. You bought Bitcoin years ago, it skyrocketed, and now you want to use those gains to buy a house. Can you do it? Yes. Is it easy? Absolutely not. Using crypto for a down payment is a paper trail nightmare. Remember, the lender needs to source every dollar. With crypto, that means you have to document the entire life cycle of the funds. First, you have to prove how you bought the crypto in the first place, showing the US dollars leaving your bank account to go to the crypto exchange. Then you need to provide complete documentation of the sale of the crypto, the transaction record showing you converted it back into US dollars. Finally, you need to show the wire transfer from the exchange into your US bank account. And just like any other large deposit, that money then needs to be seasoned. You can't just cash out your Ethereum on Monday and expect to close on a house on Friday. The volatility and anonymity of crypto make lenders incredibly nervous. You need to be prepared to provide a mountain of paperwork that connects every single dot, from dollar to crypto and back to dollar again. So whether it's mattress money, a disguised loan from a relative, or profits from a crypto wallet, the underlying rule is the same. It's the golden rule of down payments. If a lender can't trace it, they can't trust it. Your entire job as a borrower is to make the underwriter's job easy. You want to hand them a file where every single penny is accounted for with a clean, simple, and boring paper trail. The more boring your file is, the faster it gets approved. We've just navigated the minefield of where not to get your money. These are the sources that cause delays, stress, and last-minute denials. But what about the safe harbors? What are the gold standard underwriter-approved sources that will make your loan application sail through with a green light? We're about to break down the A-plus sources of funds, the ones that lenders love to see. And we'll cover everything from your 401k to a little-known strategy that can actually get the seller to help pay for your closing costs, which is a game-changer we'll explore next. Let's start with the magic trick, the one where you get the seller to help you buy their own house. It's called a seller concession or seller credit, and it is one of the most powerful, yet underutilized, tools in a homebuyer's arsenal. Here's how it works. Let's say a house is listed for $500,000. You've got your down payment saved up, but those closing costs, the lender fees, appraisal, title insurance, are a real gut punch, coming in at an extra, say, $15,000. You just don't have it. So what do? Instead of offering the $500,000 asking price, you offer $515,000, but with a crucial condition. You ask the seller for a $15,000 credit back to you at closing to be used for your closing costs. Think about what just happened. From the seller's perspective, they're still getting their net $500,000. The sales price on paper is higher, which they often like, but the cash in their pocket at the end of the day is the same. But for you, it's a complete game changer. You've just financed your closing costs. You've rolled that $15,000 into your mortgage, reducing the mountain of cash you need to bring to the table on closing day. Instead of draining your savings account to zero, you now have a cushion for moving expenses, new furniture, or that emergency fund every homeowner desperately needs. Now there are rules. Lenders cap the amount of seller concessions you can receive. For a conventional loan, it's typically between 3 and 6% of the purchase price, depending on how much you're putting down. For an FHA loan, it's usually capped at 6%, so you can't just ask for an infinite amount. And of course, the house still has to appraise for that higher value, the $515,000 in our example. If the appraiser says the house is only worth $500,000, this strategy won't work. But in a stable or appreciating market, and when structured correctly, this is your single best strategy for reducing your out-of-pocket cash requirement. It transforms a stressful cash shortage into a manageable, slightly higher monthly payment. Okay, so you've brilliantly negotiated a seller credit, but you still need the actual down payment. Where else can you look? Let's talk about your 401k. This is one of the most common sources, but it's a double-edged sword that you need to handle with extreme care. You generally have two options: a 401k loan or a hardship withdrawal. Let's focus on the loan, as it's far more common for a home purchase. The appeal is obvious. You're borrowing your own money. There's no credit check, the application is simple, and the interest rate is usually reasonable. And here's the best part. The interest you pay doesn't go to a bank. It goes right back into your own 401k account. You're paying yourself back. Lenders love this because it's a secure, documented source of funds. It's clean. But here is the giant, flashing red light warning. You are borrowing from your future. That money you pull out is no longer invested in the market, meaning you lose out on all the potential compound growth it could have generated. It's like taking a star player off the field for a few years. Your team just won't score as many points. The second and more immediate danger is what happens if you lose or leave your job. Many 401k loan provisions state that if your employment is terminated, the entire remaining balance of the loan could become due almost immediately, often within 60 or 90 days. If you can't pay it back, it's treated as an early withdrawal. That means it's subject to income tax and a 10% penalty. It's a financial trapdoor that can spring open when you're most vulnerable. So while a 401k loan is a valid and acceptable source for your down payment, you must go into it with your eyes wide open, understanding the risk to your retirement and the potential consequences of a job change. Now let's move from borrowing from yourself to receiving help from others. I'm talking about gift funds. This is how millions of first-time homebuyers get over the finish line, but it is also a place where deals go to die because of sloppy paperwork. Lenders have one primary concern when it comes to gift money. They need to be 100% certain that it is a true gift, not a secret loan that you have to pay back. An undisclosed loan would increase your debt-to-income ratio and could put your mortgage approval in jeopardy. So how do you prove it's a gift? With a paper trail so clean it squeaks. First, you need a gift letter. This is a simple signed document that states the giver's name, their relationship to you, the exact dollar amount, the address of the property you're buying, and a very specific sentence. That sentence must say something like, "This is a bona fide gift, and there is no expectation of repayment, expressed or implied." That last part is the magic phrase. Second, you need to document the money's journey from start to finish. This is non-negotiable. The lender will need to see a bank statement from the person giving you the gift, showing they had the funds available to give. Then they'll need to see proof of the transfer, a copy of the cashier's check or the wire confirmation. And finally, they'll need to see your bank statement showing the funds being deposited into your account. Do not, under any circumstances, accept a large cash gift. A giant undocumented cash deposit is the biggest red flag you can wave at an underwriter. It screams mattress money or undisclosed loan, and it can bring your entire application to a screeching halt. The money has to be traceable from their account to yours. Who can give you a gift? Typically, it has to be a close relative, a parent, grandparent, sibling, or spouse. Some loan programs allow for gifts from a fiancé, a domestic partner, or even a godparent, but you must check with your specific lender to know their rules. Follow the process, document everything, and that generous gift will be the bridge that gets you to homeownership. Finally, let's talk about the secret weapon many buyers don't even know exists: down payment assistance programs, or DPA. These are programs usually run by state or local housing authorities, designed specifically to help homebuyers overcome the hurdle of the down payment and closing costs. This isn't some obscure loophole. It's a formal system designed to promote homeownership. DPA programs come in a few different flavors. Some are outright grants. Yes, that means free money that you never have to pay back. Sounds too good to be true, but they are real. More commonly, the assistance comes in the form of a second loan, often called a silent second. This is a smaller mortgage that sits behind your main mortgage. Sometimes these loans have a 0% interest rate and require no payments until you sell or refinance the home. Other times, a portion of the loan is forgiven for every year you live in the house, and if you stay long enough, say 5 or 10 years, the entire loan disappears. These programs often have eligibility requirements, like income limits, purchase price caps, and sometimes you need to be a first-time homebuyer. But you'd be surprised how generous those income limits can be, especially in higher-cost areas. Finding them is easier than you think. A great starting point is to simply search online for your state down payment assistance program or your city first-time homebuyer program. The Department of Housing and Urban Development, or HUD, also maintains a list of state and local programs on their website. Don't assume you make too much money. Don't assume they're not available. A few hours of research into DPA could uncover tens of thousands of dollars that make the difference between renting for another 5 years and holding the keys to your own home. So you have these A-plus sources: leveraging seller concessions to cover closing costs, carefully considering a loan from your 401k, properly documenting gift funds from family, and exploring government assistance programs. Getting the money is the first major battle. But how you handle that money in the months leading up to your application can make or break your entire deal. One wrong move, one large undocumented deposit, and the whole thing can fall apart. In the next part, we're going to cover the critical rules of seasoning your funds and the simple, avoidable mistakes that sabotage countless homebuyers just before they reach the finish line. So let's talk about seasoning. No, not the kind you put on a steak. In the mortgage world, seasoning is the process of letting your down payment money sit in your bank account for a specific period of time. Think of it like this. A lender wants to see that the money you're using is truly yours, and not some last-minute, secret loan you took out that they don't know about. They need to see a history. They need to see that the money has been living in your account, paying rent and getting comfortable. The standard period for this is 60 days. Why 60 days? Because when you apply for a mortgage, the lender will typically ask for your last 2 months of bank statements. Anything that was in your account before that 2-month window is considered seasoned. It's part of your financial landscape. The lender assumes it's your money, and they usually won't ask any more questions about its origin. But any large, unusual deposit that appears within those 60 days, that's an unseasoned fund. And to an underwriter, an unseasoned fund is a giant flashing red light. Here's the core reason this matters so much, and it's the number one thing that trips people up: undisclosed debt. When a lender approves you for a mortgage, they do it based on a very precise calculation of your debt-to-income ratio, or DTI. They add up all your monthly debt payments, car loans, student loans, credit cards, and compare it to your monthly income. This ratio tells them if you can truly afford the new mortgage payment. Now imagine you're short $10,000 for your down payment. So you call up your cousin, who agrees to lend it to you. You deposit that $10,000 into your account a week before closing. The lender sees this new large deposit. They ask where it came from. You can't say it's a loan because that's a new monthly debt they didn't know about. It completely messes up your debt-to-income ratio. Suddenly, you might not qualify for the loan anymore. And if you lie and say it was a gift, that's mortgage fraud. This is the exact scenario that the seasoning rule is designed to prevent. It's a protection for the lender, but it's also a protection for you, to ensure you're not taking on a house you can't actually afford. So knowing this, let's walk through the simple, avoidable mistakes that sabotage countless homebuyers. These are the landmines you need to sidestep. First, and most common, is the mattress money mistake. For generations, people have saved cash at home. In a coffee can, under the mattress, in a safe, it doesn't matter. It's a tangible way to see your savings grow. The problem is, in the eyes of a mortgage lender, that cash doesn't exist until it's in a bank. And the moment you deposit, say, $15,000 in cash into your checking account, the clock starts. You've just made a large, unseasoned deposit. The lender will ask for the source, but you have no way to prove where that cash came from. You can't provide a paper trail for cash you've been saving for 10 years. It looks suspicious, even if your intentions are completely honest. The solution? If you have cash savings, you need to plan way ahead. Deposit that money into your bank account at least 3 to 4 months, ideally longer, before you even start looking for a house. Let it sit. Let it get seasoned. By the time you apply for a loan, that deposit will be ancient history, and it won't even show up on the bank statements you have to provide. The second mistake is playing the shell game with your accounts. This happens when people try to organize their funds right before applying for the loan. They move $5,000 from PayPal to checking, $3,000 from Venmo to savings, they sell some stock and move that over. Then they consolidate everything into one account. From your perspective, you're just getting your ducks in a row. From the lender's perspective, it's a chaotic mess of transfers. Every single one of those transfers is a transaction they have to verify. They'll want to see the PayPal statement, the Venmo statement, the brokerage statement. It creates a mountain of paperwork and delays. The pro move is to do your consolidation early. Pick 1 or 2 accounts that you will use for your down payment. Move all the money you need into those accounts months in advance. Keep it clean, keep it simple. The less noise there is on your bank statements, the smoother the underwriting process will be. The third mistake is the undocumented family loan. This is the cousin loan scenario we just talked about. You get money from a relative, but there's no official paperwork. You just deposit the check or accept the wire transfer. This is a guaranteed showstopper. Lenders have to source every large deposit. If the money came from another person, it has to be one of 2 things: a properly documented gift or a loan. If it's a loan, it has to be included in your debt-to-income ratio. If it's a gift, it requires a signed gift letter from the donor explicitly stating that the funds are a gift and no repayment is expected. There is no middle ground. You cannot just take money from a relative and call it savings. The paper trail will sink you every single time. And that brings us to the fourth common mistake, the last-minute liquidation. This often happens with people who have money in stocks, crypto, or a 401k. They wait until they have a signed contract on a house, and then they sell their assets to get the cash for the down payment. The money hits their bank account, and just like all the other examples, it's a large, unseasoned deposit. Now, this isn't automatically a deal killer like an undocumented loan might be, but it creates a major documentation hurdle right when time is most critical. The lender will need to see the full statement from your brokerage account or 401k showing the assets before the sale, the transaction itself, and the funds leaving that account. Then they need to see the corresponding deposit into your bank account. If the names don't match perfectly, or if there are any delays in getting that paperwork, it can push your closing date back. The smarter way is to either liquidate those assets well in advance and let the cash season, or if you must do it last minute, have all of that paperwork printed and ready to hand to your loan officer the moment you make the transfer. So what's the big takeaway here? It's that the 2 months leading up to your mortgage application are a financial quiet period. Your bank account is under a microscope. The goal is to make your statements as boring as possible. No large, mysterious deposits. No weird, complicated transfers. Just your regular income hitting the account and your normal bills going out. Think of it this way, your loan officer and the underwriter are on your team. They want to approve your loan, but they have to follow strict federal regulations. Your job is to make it easy for them to check the boxes and say yes. The best way to do that is to be proactive. Months before you apply, sit down and look at your money. Is it in cash? Deposit it now. Is it spread across 10 different apps and accounts? Consolidate it now. Are you selling a car or a boat to get funds? Keep a copy of the title and the bill of sale. Every dollar needs a story and a paper trail. If you prepare that story ahead of time, the seasoning process becomes a non-issue. You're simply presenting the lender with a clean, clear financial picture that proves the money is yours, and you're ready to buy a home. So we've talked about what happens when you use your money. But what if mom and dad are helping out? Getting a gift for your down payment sounds simple, but one wrong move with a gift letter can get your loan denied just as fast as an unseasoned deposit. In the next part, we'll break down the exact step-by-step process for accepting gift funds the right way, including the one sentence that must be in that gift letter to avoid disaster. So let's cut right to the chase. The one sentence that absolutely must be in that gift letter, the one that can make the difference between approval and denial, is this: this is a bona fide gift, and there is no expectation of repayment. I'll say it again. This is a bona fide gift, and there is no expectation of repayment. Why are those 12 words so powerful? Because they address the lender's single biggest fear about gift funds: that the gift isn't a gift at all. It's a secret loan, an undocumented, off-the-books debt that you'll have to pay back. And an undisclosed debt is a mortgage underwriter's worst nightmare. Think about it from their perspective. They have meticulously calculated your debt-to-income ratio, or DTI, to determine exactly how much house you can afford. They've factored in your car payment, your student loans, your credit card bills. Their entire approval is based on that number. Now imagine they approve your loan, and a month after you close, you suddenly have a new secret $500 a month payment to Uncle Bob for that gift he gave you. That payment could be the straw that breaks the camel's back. It could be the very thing that pushes your budget over the edge and leads to a default down the road. The lender has no way of knowing about this secret loan, so they protect themselves by demanding absolute proof that your gift money is truly a gift. That one sentence is your legal declaration. It's the donor putting in writing, for the bank's records, that they cannot and will not come after you for that money. It turns a suspicious pile of cash into a legitimate, acceptable source of funds. But just having that sentence isn't enough. You have to follow the entire process perfectly, because any misstep can raise a red flag. So let's walk through the exact 4-step process for accepting and documenting gift funds the right way. Step 1 is the conversation. Before any money changes hands, you need to sit down with the person giving you the gift, your parent, your grandparent, your sibling, and explain the rules. This isn't just about asking for money. It's about preparing them for the paperwork and the scrutiny that will follow. You need to tell them, I am so incredibly grateful for this, but for the bank to accept it, we need to document it in a very specific way. I'm going to need you to sign a letter, and the bank might even ask to see a copy of your bank statement to show where the money came from. Setting this expectation up front is crucial. The last thing you want is for your generous parent to get offended or spooked when the lender asks for their personal financial documents. Frame it as us against the bank's rules, not me asking you for invasive documents. Step 2 is the gift letter itself. This is the official document. It doesn't need to be fancy or written by a lawyer, but it must contain specific pieces of information. Get a pen because you'll want to write this down. First, the donor's full name, address, and phone number. Second, their relationship to you, the borrower. Third, the exact dollar amount of the gift written out. Fourth, the date the funds were transferred. Fifth, it needs to state the funds are being used for the purchase of a specific property, and you should include the full property address. And finally, it needs that magic sentence. This is a bona fide gift, and there is no expectation of repayment. The letter must be signed and dated by both the donor and you, the borrower. Every single person giving money and every single person receiving it on the loan application needs to sign. Step 3 is the transfer of funds, and this is where most people make a catastrophic mistake. Do not, under any circumstances, let your family member give you cash. A giant cash deposit in your bank account is the reddest of red flags for a lender. It's impossible to source, and they will assume the worst, that it's from an illegal source or an undocumented loan. You need a clean, clear paper trail. The best way to transfer the money is a wire transfer directly from the donor's account to your account. The wire record will show exactly who it came from, their bank, the date, and the amount. It's indisputable. The second best option is a cashier's check. The donor goes to their bank, gets a check made out to you, and you deposit it. You'll have a copy of the check and the deposit slip, creating a very clear trail. A personal check is okay, but you have to wait for it to fully clear, and you need to provide a copy of the front and back of the canceled check. The key is to create a transaction that is as transparent as a clean pane of glass. Now for step 4, the part that surprises almost everyone. Sourcing the donor's funds. You've done everything right. You had the conversation, you have a perfect gift letter, and you have a clean wire transfer receipt. You submit it all to your lender, and then they come back with one more request. We need to see the donor's most recent bank statement to show they had the funds available to give. This is where people get upset. Why do they need to see my mom's bank account? It's none of their business. But it is their business. They need to close the final loop. They need to prove that the money didn't just mysteriously appear in your mom's account a day before she gave it to you. Because if it did, that suggests she might have taken out a loan herself to give you the money, which, in the bank's eyes, is just another form of you taking on undisclosed debt. So, the lender will want to see her bank statement showing the gift amount in her account, and that it was seasoned, that it was her money to begin with. This is why that initial conversation in step 1 is so important. Preparing your family member for this possibility makes the process smooth instead of stressful. It's also important to know that the rules can vary slightly depending on your loan type. FHA loans, for example, are generally more flexible and allow gifts from a wider range of sources, including close friends with a documented interest in your life. Conventional loans, backed by Fannie Mae and Freddie Mac, are typically stricter, usually limiting gifts to family members. VA and USDA loans have their own specific guidelines as well. This is where your loan officer is your best friend. They can tell you the exact rules for your specific loan program. Now, what if you don't have a family member who can give you a $20,000 gift? Are you just out of luck? Not at all. This brings us to another, often overlooked, source of down payment money. Down payment assistance programs, or DPAs. These are programs run by state, county, or local housing authorities, and even some nonprofits, designed specifically to help homebuyers overcome the down payment hurdle. They are a game changer for thousands of people. These programs can come in a few different flavors. Some are outright grants, which is free money that you never have to pay back. These are the holy grail, but they're also the rarest and often have strict income limits or are targeted for specific professions like teachers, firefighters, or first responders. The more common type of DPA is a silent second mortgage. This is where the program gives you the money for your down payment, say $15,000, in the form of a second loan on your property. It's called silent because it often has a 0% interest rate and requires no monthly payments. So it's free money, right? Well, not exactly. The catch is how it gets paid back. Some of these silent seconds are forgivable. For instance, the loan might be forgiven at a rate of 20% per year. So if you stay in the home for 5 years, the entire $15,000 loan vanishes. You never have to pay it back. But many others are not forgivable. They simply become due and payable whenever you sell the home, refinance, or pay off your primary mortgage. So when you sell your house in 10 years, you'll have to pay back your main mortgage plus that original $15,000 from the DPA out of your sale proceeds. It's an interest-free loan, which is amazing, but it's still a loan you eventually have to repay. This is where you have to read the fine print with a magnifying glass. Because some of these assistance programs, while sounding fantastic, come with hidden strings that can cost you dearly. They might be offering you $10,000 for your down payment, but to get it, you're forced to accept a primary mortgage with an interest rate that's a full percentage point higher than the market rate. Over the life of a 30-year loan, that single percentage point could cost you tens of thousands of dollars in extra interest, far more than the assistance you received up front. They give with one hand and take much, much more with the other. This is the dark side of down payment assistance. And it's a trap that countless eager homebuyers fall into. So how do you navigate this minefield? How do you find the golden key without getting locked in the golden cage? Starts with a shift in perspective. You must stop looking at down payment assistance as a handout and start scrutinizing it like a business deal. Because that's exactly what it is. You are entering into a contract, and the devil, as they always say, is in the details. The very first question you need to ask about any DPA program is the simplest, yet most important. Is this a grant, or is it a loan? A grant is a gift. It's free money. It doesn't need to be paid back, ever. True grants are the unicorns of down payment assistance. They're rare, often highly competitive, and usually offered by local nonprofits or specific city housing initiatives. If you find a true grant, you've hit the jackpot. But most programs aren't grants. They're loans. And that one word, loan, changes everything. Once you've established it's a loan, your next question must be, what are the repayment terms? This is where the landscape gets complicated. The most common and dangerous type is the one we just discussed, a fully repayable second mortgage with its own interest rate. But there are other, more favorable kinds. You might find what's called a silent second, or a deferred payment loan. This means you get the money for your down payment, and you don't have to make any monthly payments on it. It just sits there silently as a lien on your property. The catch? It becomes due in full when you sell the house, refinance, or pay off your primary mortgage. So if you get a $10,000 silent second loan and sell your house 10 years later, you'll have to pay back that $10,000 from the proceeds of the sale before you see a penny of profit. It's not free money, but it's essentially an interest-free loan that helps you get in the door, which can be a fantastic deal. Even better is the forgivable loan. This is the holy grail of DPA loans. Here's how it works. A housing authority might give you $15,000. The loan has a forgiveness period. Let's say it's 5 years. For every year you live in that house as your primary residence, a portion of that loan is forgiven. In this example, $3,000 would vanish each year. As long as you stay in the home for the full 5 years, the entire $15,000 loan disappears. It effectively becomes a grant, but with one major string attached. You have to stay put. If you sell after 2 years, you'd have to pay back the remaining $9,000. These programs are designed to encourage neighborhood stability, and they can be a life-changing opportunity for buyers who plan to plant roots. But this brings us to the third and most critical question. What are the hidden strings? Beyond interest rates and repayment, there are other clauses buried in the fine print that can turn a dream into a nightmare. We already covered the biggest one, being forced into a higher interest rate on your main mortgage. But there are others. Look for something called a recapture clause. This is especially common in programs tied to mortgage credit certificates or certain housing bonds. A recapture clause can mean that if you sell your home within a certain period, often 9 years, and your income has increased significantly, you may have to pay a portion of your profits back to the IRS as a penalty. It's a tax trap designed to prevent people from flipping houses with government assistance, but it can catch long-term homeowners by surprise. Another string is resale and equity sharing restrictions. Some nonprofit programs, especially those in high-cost cities, will help you with a down payment in exchange for a share of your future appreciation. Let's say they give you $50,000, which represents 10% of the home's value. When you sell the house 10 years later, not only do you have to pay back the $50,000, but you also have to give them 10% of whatever profit you made. Suddenly, the assistance has turned into a very expensive equity partner you never realized you had. Let's make this real. Meet two homebuyers, Alex and Maria. Both are teachers in the same city, earning similar salaries, both struggling to save 20% for a down payment. Alex is in a hurry. He finds a statewide DPA program online that promises to cover your down payment. He signs up, gets $15,000, and closes on his condo. He's ecstatic, but he didn't read the fine print. His main mortgage has an interest rate that's a full percentage point higher than the market rate. The $15,000 is a second mortgage at an even higher rate. Over the next 30 years, Alex will pay over $40,000 in extra interest, all for that initial $15,000. He got a house, but he's shackled to a financially draining deal. Maria, on the other hand, is patient. She resists the easy online offers. Instead, she goes local. She calls her city's housing department. She talks to a HUD-approved housing counselor, a free service, by the way. They tell her about a neighborhood stabilization program specifically for educators. It's a $20,000 forgivable loan. As long as she stays in the home and continues teaching in the district for 5 years, the entire loan is forgiven. It vanishes. She has to attend a weekend homebuyer education course, but that's the only catch. Her primary mortgage is a standard, competitive rate loan. 5 years later, Maria has $20,000 of instant equity that cost her nothing. Alex is still just chipping away at his mountain of extra interest. Same goal, same financial starting point, but vastly different outcomes, all because one of them treated DPA like a business deal and the other treated it like a lottery ticket. The lesson here is profound. The best assistance programs are almost always local. They're not advertised on flashy websites with 1 to 800 numbers. They're run by your city, your county, or a local nonprofit. They want to invest in their own community, in their nurses, their firefighters, their teachers. Your first step should never be a Google search for down payment assistance. It should be a call to your local housing authority. But even with the best DPA program, you're still playing within the traditional system. You're trying to solve a down payment problem. What if the problem isn't the down payment at all? What if the real hurdle is the massive monthly payment that follows? The mortgage, the taxes, the insurance, the total cost of carrying the home. Because even if you get a forgivable loan for your entire down payment, you still have to qualify for and afford the mortgage itself. And for many people, that's where the dream truly dies. This reveals a deeper truth about homeownership in America today. We are so hyper-focused on the down payment, on this one single barrier to entry, that we ignore the much larger financial reality of the 30-year commitment that comes after. The industry wants you to focus on the down payment because they can sell you products to solve that problem, high-interest loans, assistance programs, you name it. But what if there was a way to sidestep that problem entirely? A strategy to not just lower your down payment, but to have someone else pay your mortgage for you? This isn't a fantasy. It's a strategy that thousands of regular people just like you, use to build wealth and achieve financial freedom through real estate. It's a method that fundamentally rewires the home buying equation. Instead of your house being your biggest expense, it becomes your biggest asset, generating income from day one. It's about turning a liability into an engine for your financial life. We've been focused on how to get a little bit of help to buy a house in the conventional way. But the truly game-changing approach isn't about getting help. It's about changing the game itself. And this is where the entire conversation about down payments gets turned on its head. For weeks, months, maybe even years, you've been asking the question, how can I possibly save enough money for a down payment? It's a question rooted in scarcity. It assumes the down payment is a massive wall you have to scale all by yourself. But the game-changing question is different. It's not, how can I afford my house? It's, how can my house afford itself? This one little shift in perspective changes everything. It reframes the house from being your life's biggest liability into becoming your most powerful asset. Let's start with the most accessible way to do this, a strategy known as house hacking. The name might sound technical, but the concept is as old as land ownership itself. You buy a property with more than one living space. A duplex, a triplex, a fourplex, you live in one of the units, and you rent out the others. Suddenly, you're not just a homeowner, you're a landlord. And your tenants are not just paying rent, they are paying your mortgage. In the best case scenarios, the rent from the other units covers your entire monthly mortgage payment, plus taxes and insurance. You are effectively living for free. Think about the sheer power of that. Your single biggest monthly expense, housing, is completely eliminated. All that money you would have been pouring into a mortgage payment can now be used to build wealth, invest, or save for your next property. But how does this connect to the down payment? This is the truly brilliant part. Lenders know this strategy works. An FHA loan, for example, allows you to buy a property with up to 4 units with as little as 3.5% down, as long as you live in one of them. And here's the kicker. The bank will allow you to use the projected future rental income from the other units to help you qualify for the loan. Let me repeat that. The bank will count money you haven't even received yet, the rent from your future tenants, as part of your income. This means you can qualify for a much larger loan and purchase a more valuable, income-producing asset than you ever could with a standard single-family home. So, for a slightly larger down payment in absolute dollars, you're not just buying a place to live, you're buying an income stream. You're buying a machine that pays for itself. You could buy a $200,000 condo that costs you $1,500 a month. Or you could buy a $400,000 duplex, live in one half, and have the tenant in the other half pay your entire mortgage. It's a completely different universe. And you don't even need a multi-family property. You can house hack a regular single-family home by renting out the spare bedrooms to roommates. Or you could buy a house with a finished basement or an in-law suite and rent that out. The principle is the same. Make your asset work for you. But let's say you can't find the right multifamily property, or the idea of being a landlord right away is intimidating. There's another way to change the game, one that involves bypassing the big banks altogether. It's called seller financing. This is where the person selling the house becomes your bank. Instead of you going to Chase or Wells Fargo for a loan, you make your monthly payments directly to the seller. Why on earth would a seller agree to this? Well, think about it from their perspective. Maybe they own the home outright and don't need a big lump sum of cash. They'd rather have a steady, reliable stream of income for the next 10, 20, or 30 years, like a personal pension plan. Maybe the property is unique or needs some work, making it difficult to get a traditional bank loan. Or maybe the seller just wants to avoid paying hefty realtor commissions and closing costs, and they see you as a serious, committed buyer. With seller financing, the down payment is no longer a rigid rule set by a faceless institution. It's a point of negotiation between two human beings. The bank might demand 20% down, no exceptions. But with seller financing, you might be able to negotiate 10%, 5%, or even 0% down if you can offer the seller a slightly higher interest rate or a shorter loan term. You are creating a win-win scenario. The seller gets a reliable income and a faster sale, and you get into a home with terms that are custom-fit to your financial situation. It requires more work. You have to find these sellers, build trust, and negotiate a deal. But it completely removes the biggest barrier to entry for most people. Now let's stack one more game-changing idea on top of this. This strategy is for those who aren't afraid to get their hands a little dirty, and it's how real wealth is built in real estate. It's about buying potential, not perfection. Most people shop for homes like they're shopping for a new TV. They want something shiny, new, and move-in ready. As a result, they pay top dollar. The game changer is to do the opposite. You look for the ugliest house in the best neighborhood. The one with the shag carpet, the avocado green kitchen, and the peeling paint. Why? Because that house has a secret. Forced appreciation. Market appreciation is when your home's value goes up because the market around it improves. It's passive. You just sit and wait. Forced appreciation is when you physically increase the value of your home through your own efforts. You buy that ugly house for, say, $200,000, knowing that with $50,000 in renovations, it will be worth $300,000. You're not waiting for value to happen. You are creating it. But wait, you're thinking, I don't have $50,000 for renovations on top of a down payment. You don't need it. There are specific loan products like the FHA 203K loan or Fannie Mae's Homestyle loan that are designed for this exact purpose. They roll the cost of the purchase and the cost of the renovations into a single mortgage. So you get one loan that covers everything. You put down a small percentage on the total amount and you get to work. 6 months later, the renovations are done. You've transformed that ugly duckling into a beautiful swan. And now your home is worth $300,000, but you only owe $250,000. You have instantly created $50,000 in equity, in pure wealth. And here is the masterstroke. After a year or so, you can do what's called a cash-out refinance. You go to a bank and get a new loan based on the new, higher value of your home. You get a new loan for, say, 80% of $300,000, which is $240,000. You use that to pay off your original renovation loan, and what's left over? You get a check. A check that could be big enough to pay back your entire original down payment and all your renovation costs. You have effectively bought a house, created wealth out of thin air, and pulled your initial investment right back out. Your down payment is no longer a sunk cost. It's a seed you planted, harvested, and now hold in your hand again, ready to be planted in the next property. This is how you turn one down payment into a real estate portfolio. These strategies, house hacking, seller financing, buying, and forcing appreciation, they aren't just clever tricks. They represent a fundamental mindset shift. They are the difference between being a passive consumer of housing and an active creator of wealth. The house stops being a ball and chain around your ankle and starts becoming the engine of your financial freedom. We've talked about saving, we've talked about assistance, and now we've talked about changing the rules. But there's one final piece of the puzzle. The one thing that separates those who succeed from those who stay on the sidelines forever. It's not about money at all. It's about conquering the single biggest obstacle you will face. Yourself. The person staring back at you in the mirror. Your own mind, your own fear, your own hesitation. The single biggest obstacle to buying a home isn't the bank, it isn't the market. And it isn't even the down payment. It's analysis paralysis. It's the voice in the back of your head that whispers, what if? What if I buy at the very peak of the market? What if interest rates drop right after I lock in my loan? What if I lose my job? What if I find a better house a month after I close? What if I don't want to live here in 5 years? These questions can be paralyzing. They can keep you renting for years, even decades, always waiting for the perfect time that never arrives. Because here's the secret. There is no perfect time. There is only your time. And your time is when you are financially and emotionally ready. We've spent this entire series breaking down the numbers, the percentages, the acronyms. We've demystified FHA loans, conventional loans, PMI, and DTI. We've talked about down payment assistance, gift funds, and creative saving strategies. We did all of that for one reason: to silence that voice of fear with the undeniable power of facts. Knowledge is the antidote to anxiety. So let's tackle those fears head-on, one by one, using the knowledge you now have. First, the biggest fear of all. What if I buy and the market crashes? This is the ghost that haunts every potential homebuyer. You see headlines about bubbles and corrections and you freeze. But let's reframe this. You are not a day trader flipping stocks. You are buying a home. A place to live, to build a life, to create memories. The goal isn't to time the market perfectly over 6 months. The goal is to build wealth and stability over 6 years, 10 years, 20 years. Historically, over any significant stretch of time, real estate in the United States has proven to be one of the most reliable and powerful wealth-building tools in existence. People who wait for the absolute bottom of the market almost always miss it. They wait, prices dip a little, they get scared it'll go lower, and then before they know it, the market recovers and they're priced out further behind than when they started. The most successful homeowners didn't have a crystal ball. They bought a home they could afford in a place they wanted to live when they were ready. They focused on time in the market, not timing the market. And every single month, with every mortgage payment, they were paying themselves, building equity, turning their housing expense into a forced savings account. That's a financial superpower renters simply do not have. The second fear. What if I don't want to be tied down? This is the fear of commitment. You think buying a home means you're locked into one spot for 30 years. That's a myth. The average homeowner in the US stays in their home for about 13 years, and for first-time buyers, it's often much shorter. Think of your first home not as your forever home, but as your for now home. It is a launch pad. Let's say you buy a home and live there for 5 or 6 years. You're building equity that entire time. When you're ready to move, for a new job, a growing family, or just a change of scenery, you don't start from zero. You sell that home and you walk away with your equity. That equity becomes a massive down payment on your next home, a bigger home, a home in a more expensive city, whatever you want. It's a stepping stone. Renting, on the other hand, is a treadmill. You can run on it for 10 years, and when you step off, you're in the exact same place you started, having built zero equity for yourself. Your landlord, however, will be very grateful. The third fear is the fear of being house poor. This is a legitimate concern. It's the nightmare scenario where you can afford the mortgage but nothing else. No vacations, no dinners out, no savings. Just the house. But this is precisely why you watch this entire series. The fear of being house poor comes from a lack of preparation. Comes from ignorance. But that's not you anymore. You now understand the components of a mortgage payment: principal, interest, taxes, and insurance. You know that your debt-to-income ratio is the key metric the bank uses, but more importantly, it's the key metric you should use to determine your own comfort level. You know that getting pre-approved doesn't mean you should borrow the maximum amount. It means you now have a ceiling, and you should shop comfortably below it. You know how a larger down payment can lower your monthly payment and eliminate PMI, giving you more breathing room. The entire purpose of understanding your down payment is to architect a financial situation where you are in control, where your home serves your life, not the other way around. Being prepared isn't just about qualifying for the loan. It's about thriving after you get the keys. And finally, there's the fear of the process itself. The complexity, the paperwork, the feeling that you're going to miss something or get taken advantage of. Before you started this journey, that was a valid fear. The world of mortgages is intentionally confusing, but look at where you are now. You know the difference between an FHA loan and a conventional 97. You know why 20% down is a myth. You know where to look for down payment assistance programs. You are armed with the vocabulary and the concepts to walk into a lender's office and have an intelligent, confident conversation. You are no longer a passive passenger. You are the pilot of your own home buying journey. The down payment is the final boss of the preparation phase. It's the tangible proof of your discipline and your commitment. Saving it is hard. It requires sacrifice. But every dollar you put away is a vote for your future self. It's a statement that you are ready to stop building someone else's dream and start building your own. So what now? Where do you go from here? You don't go from watching this video to buying a house tomorrow. You take the next smallest logical step. Tonight, open a spreadsheet or grab a notebook and calculate your real debt-to-income ratio. Get an honest look at where you stand. This weekend, go online and find the websites for your state and county housing finance agencies. Look up the down payment assistance programs we talked about. See what you might qualify for. You might be shocked at what's available. Next week, use an online mortgage calculator. Plug in the price of a modest home in your area. Play with the numbers. See the difference in the monthly payment between a 3.5% down payment and a 10% down payment. See how much PMI would cost and how quickly you could get rid of it. Make the abstract real. These are not giant leaps. They are small, manageable steps. But they are the steps that turn the dream of homeownership into a project plan. You have the knowledge. You have the tools. You've put in the time to learn what 99% of people never will. The only thing left is to conquer that final obstacle, your own hesitation. Give yourself permission to believe that this is possible for you. It's not about being perfect. It's not about timing the market. It's about being prepared, being patient, and taking action when your time comes. The journey to homeownership is one of the most challenging and most rewarding things you will ever do. And it starts not with a signature on a dotted line, but with the decision that you are worthy of it and the courage to take that first small step forward. You can do this.